Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Dr. Soumya Kanti Ghosh, Group Chief Economic Advisor at State Bank of India, joining in. Welcome to the show, Soumya, and it's a pleasure to speak to you as well after a really long time. And hope everything is safe at your end.
Yes, thank you. Yes, good to speak to you. And things are much better than what it was at least even 1 month back. So good to have that feeling.
Absolutely, Soumya. Soumya, there was a lot of resistance in everyone's mind as to how the economies are going to react post the pandemic or during the pandemic as well. However, when we talk about it, it seems that we've proved far more resilient than expected after the terrible first quarter of COVID. Do you think this is something which will continue and it will bode well for the short term?
Yes, I think the before I take that point, I think let me just take a step back and see why this has happened. I think, as all of you know, at the end of first quarter, all of us were expecting that the deceleration in the Indian economy could well be in double digits, if not worse. But I think things started to move dramatically after September, and as of today, I think most of us believe that the contraction will be in single digits, and that's actually a 300 to 400 basis points improvement by most of the agencies over what it was put out last year, including even the Reserve Bank of India. And the Reserve Bank of India estimates actually changed in very short time, within a span of I think fortnight or so. So that gives you an idea of how quickly the economy recouped. Apart from the resilience part, which I'll come to that, the most important thing where the economy recouped so faster was that the was that there was a lot of behavioral changes in across the people, and these behavioral changes actually are similar to, even I think the changes when the public actually doesn't change, has not even changed much. We had done a research at that point of time to find out that uh, significantly and amazingly, that when what happened in London plague time, most of those behavioral habits were actually replicated during the current pandemic also. So just take one of a few examples why what was which of those behavioral habits changed in the recovery. The first thing was that as people wanted to shun transport, so there was a lot of people buying entry level cars. So that actually led to a quick level of recovery in the entry level segment. The second, for example, behavioral change the people want was that people actually shifted a lot of their purchases to online and also to health expenditure. So that's why you will see that the insurance segment actually has been doing very well. And most of us actually also shun the habit of going out and spending from digital transactions. So that's why the UPI transaction, all the transactions are actually increased significantly manifold from the February levels. And the consumers also has been deleveraging. So there has been, and the most important point, by the second quarter growth significantly rebounded from the first quarter. That was also in fact a change of behavioral habit. What happened was that if you look into the Q1 GDP data, the loss was around 11 lakh crores, and Q2 GDP data, the loss actually narrowed down to 2 lakh crores. And what happened was that the loss in the manufacturing sector, the manufacturing sector was able to recoup 93% of the losses than what happened in first quarter in Q2. And the service sector, which is specifically the transport sector, communication and broadcasting, that was able to recover 80% of the losses happened in the first half. So what actually happened was that economy, which was in a strictly lockdown mode, after it opened up in July, goods were transported across the boundaries of India, and therefore you saw a significant surge in the transportation segment, which was railways is one of them. There's also cargo movement, there's to some extent port movement, and there's also this communication, because people sitting at home consume big amount of data, and of course broadcasting, because people have been also enjoying TV. So again, it was a change in behavioral habit of the part of the people staying at home, and that's why leading to a recovery in some of the service sector component, and that's which also led to an infrastructure in the manufacturing sector. So to cut the long story short, yes, we have been surprised by the resilience of the Indian economy, but that is a large part of the change in behavioral habits. But as we move along, it will become very important to how do you move ahead in the 2021 once the pandemic actually comes to an end in terms of the virus, in terms of the vaccination starting.
Right. So, Soumya, taking all of that you've said into consideration, if you talk about resilience, for India, we've had the smallest fiscal stimuli amongst major nations. So, does this mean that the long term scar of COVID, for example, if you even take the debt to GDP ratio, will be correspondingly shallower, aiding the recovery faster in 2021?
No, I agree with you to some point of view, but let me also mention an important point over. I think there is also an, as all of us know, debt to GDP ratio this year could be very in excess, which could be more than 90%. Our projections are around 88%, but I think it could be more than 90%. But what you mean to know, you also need to admire the RBI because of the significant steps, unconventional monetary policies which it has issued in the economy rebounding back. And I think we should acknowledge that because of the central bank also, a large part of this economy rebounding is because of the central bank efforts of keeping their liquidity in extended surplus, reducing to lower amount of financial stability coming back into the market, faster risk transmission. But what it has done is basically, since you have kept the liquidity in surplus mode, the what an important point is that the debt to GDP, the interest payment has been actually on the lower side. Right. So what you should actually look into is that the interest payment as a percentage of GDP, which I am sure will come down significantly next year. So even if debt to GDP ratio goes up, if the interest payment to GDP ratio comes down, and this is going to happen because the government largest borrowing program of 12 trillion in the current fiscal, but the government has been able to borrow at the lowest rate in the last 16 years. So if that is the case, I think this debt to GDP ratio numbers could become sustainable because you will be able to pay back with a lower amount of interest rate. Regarding your second point, if there is scarring remains, yes, definitely there is scarring. The most important segment is the labor market. If you look into companies, even small companies with listed companies with turnover of less than 50 crores, they have cut employee costs much more than what the listed companies of, say, revenue more than 500 crores have done. And there has been a complete dichotomy in terms of contractual laborers losing their jobs than the permanent laborers. There has also been salary squeeze, salary, and so all these things, as all of us know, happen. So there has been labor market imperfections. So what I want that to happen is that next year the government should not, I mean, ideally extend to target and fiscal consolidation drive. The roadmap should be laid completely open, because with an if the real GDP contracts by say around 7.4%, the nominal GDP should ideally contract by around 4 to 4.5%. So therefore, to reach the level of nominal GDP, what we had promised in this year's budget, which we will obviously reach in an FY22 budget. So two so 2 years of permanent output loss, and I think the fiscal consolidation, the government should actually try to pull ahead in terms of a higher expenditure next year, so that the market also will be willing to give a higher fiscal deficit number to it, and that will be the most important thing to look out for in the budget. Because if that number may be a little bit on the tighter side, I think that could actually dampen the recovery prospects a bit. So we are all looking out for that in the budget.
Right. And then with this, if you talk about India, the growth has been steadily falling before the pandemic as well. I think from a 8.3% in FY17, we went to 7%, another 6.1%, and then 4.2% in the subsequent years. So this was already telling us that, yes, there are deep structural issues and problems. So taking these numbers into consideration and the pandemic, do you think the new normal for GDP growth, maybe say 6.5%, rather than that 7 to 8%, until all the problems are tackled?
Now, of course, I think 6% of GDP, I think 6% of GDP could be a reasonable potential output GDP number in the short term. And my aim is our projections are actually a double-digit GDP growth in next year. It could be at 11%, but that is on a minus 7.4% real GDP contraction. So the actual story will come about not next year, but FY23, when you will see that when the economy recovers. So having said that, my sense is that the government consolidation, the fiscal consolidation path should be rewritten, and there are already murmurs of making it within a range than a number. So I think these are all numbers should be taken up for consideration. But our sense is that the government, the economy now needs fiscal support, because monetary policy has reached, I think, a dead end in terms of any rate cuts, because inflation is unlikely to decline in a hurry, given that there has been a lot of behavioral changes in consumer habits, consumer preferences in the last year, because consumers are not consuming services right now, and they will consume services with a gusto next year. So if I take all these factors into point, if monetary policy space is almost exhausted, I can say it's exhausted, if I to be very precise. I think fiscal policy should have to play the role of pivoting the economy to a higher growth trajectory next year.
Right. And then with this, how important will inflation be for the RBI? Because that's something which they cannot really ignore. So talking about inflation as well, what would your outlook be? And do you think the inflation targeting framework needs to be renewed? And should India abandon this? And if they do so, can it actually accommodate growth according to you?
Now, let me come to the second point, which is in terms of inflation targeting. I think people may have different opinion about inflation targeting, whether it is working in India with food as a 46% weightage. But my strong support is that once that inflation targeting has been rolled out for the central bank, any getting back out of this inflation targeting will actually do a lot of damage and credibility to the reputation of the central bank. And as all of you know, monetary policy is all about managing expectations. We have heard noted economists like Blinder, like Woodford, any with like Mervyn King, the former England central bank, former governor of Bank of England. Everybody talks about how we manage the expectations. The RBI has actually done that job remarkably well in terms of an explicit communication to the market. So from that point of view, my sense is that there is possibly not going to be any rate cuts next year. But given the fact that RBI given the guidance that it will continue to look through unconventional monetary policy and inflation targeting, the important point we should know is that it is looking through the cycle. It is not at point of the cycle, so it is flexible inflation targeting. And if you actually the RBI looks through the cycle and allows, and for some of the inflation numbers like 6 for the last 6-7 months, several times it has been higher than 6%, but the RBI has looked through it and now it is coming down. I don't see any reason that if the RBI looks to the cycle and retains the inflation targeting in its original form, because any type of tweaks or anything to that could actually harm the prospects. And now I think the inflation targeting regime is starting to work well, given the fact that there has been some accommodative stance on the part of RBI in how to look through the numbers. Regarding the first point in terms of the inflation numbers, I think inflation is not going to go down in a hurry. The problem has been that if you again give me a minute over here, the higher inflation numbers is actually because of a statistical artifact, because you are not consuming any of the services. And if you are not consuming services in any statistical exercise, the weights of the services get normally adjusted to the foods. And if the food prices have been going up, so that's why the inflation numbers look to be on the higher side, when in the reality it may not be that significantly higher. But our sense is that inflation is unlikely to come down in a hurry, whatever are the reasons we are giving out, and maybe only it could go meaningfully below 5%, maybe towards the July and August next year. But this year inflation average is at 6.5%. Next year, we are looking at an inflation average between 4.5 to 5% as of now. So I'm a little bit bothered about the inflation trajectory as of today. So that's why I've ruled out any rate hike at the beginning.
Right. And then with this, if you talk about the government spends and what they should do on the fiscal support side, do you think there is need, say, for a counter-cyclical fiscal support from the government? And do you think that the government might be able to spend in the fourth quarter to resurrect growth further?
Now, see, I think the most important point is that if you look to the July to September numbers, the government consumption expenditure actually declined by 18% in real terms, even but even then the economy actually recovered. So we are actually in a case where the economy was doing well, but the government was not spending that much. So therefore, there is enough ammunition on the part of the government to spend in the third and fourth quarter, or at least maintain the level of the expenditure, which they may not have done to the extent which we have liked in the first two quarters. So this is point number one. The point number two is that next year is going to be very crucial in terms also of revenue and expenditure. I think next year the most important part of the revenue will be the non-tax revenue, the disinvestment receipts, which actually this year, last year the number was around 2.1 lakh crores. This year the numbers could be maybe even less than 50,000 crores. So that is one segment where you will see a huge jump of the government in terms of asset sales. But my sense is that next year budget also should have, as you know, that also has to take into account the expenditure on the part of the vaccine, which could be close to 1 lakh crores. So that's an additional 1% of GDP expenditure which has to be taken into consideration, which the government cannot avoid. So if I take all these factors into consideration, I think next year budget number will be very crucial in terms of the expenditure containment and in terms of the revenue mobilization. Any aggressive push towards going to maybe towards a 3.5 or 3% number, maybe over the next 1 or 2 years, could be not in the interest of the economy, and fiscal policy should always be counter cyclical. But in the Indian context, I think in the last 1 or 2 years it has been pro cyclical. So my sense is that go for a targeted fiscal one, but at least ensure that the fiscal policy have credibility, at least lay down that whereby we use the revenue mobilize in terms of the expenditures. If you say that we are going to expenditure, say this much on health, this much on education, this much on vaccine, I think that will be taken well by the market.
Right. And with this, Soumya, moving from here on, if you talk about our current account as well, yes, a large external surplus is something which will be positive from a macro stability point of view. But do you think that's something which will actually reflect also that growth is going to be weak?
Yes, that actually reflects to some extent that growth is driven to be weak, and that also opens up the predicament of the central bank policy trilemma, because it has been the if you look at the foreign exchange reserves, the last time foreign exchange reserves dropped by more than 100 billion, it was 110 billion in the year of 2008, and this year I think the numbers of foreign exchange reserves increase should be even higher than 110 billion. So in a situation when there is significant amount of foreign capital inflows, the RBI actually also has been mopping up dollars, and that is lead to, and in trying to stop the rupee from appreciating, but that is also leading to a lot of liquidity injection into the economy. That has resulted in the short-term rates going below the reverse repo rate. So that could actually reverse engineer some sort of a financial instability in the banking system, maybe 1 or 2 years down the line, because if lower rated borrowers are borrowing at such low rates. So all these complications are over there. But my sense is that the Reserve Bank has to follow a very balanced and delicate management in terms of these capital flows. And BOP, and we must know that BOP is likely to be in a surplus mode this year, maybe around 75 billion. Next year also is going to be a surplus. So in effect, and better current account deficit number, and we will be in current account surplus possibly this year of 1 to 1.2% of GDP. That will be the first time since 2004. So if I take all these factors into consideration, I think yes, it's a good thing, but it also poses challenges of the central bank in terms of liquidity management, currency appreciation, and monetary management.
Right. So are we trying to say that we should not expect the current account to return to a deficit as growth returns over the next few quarters?
That will depend on how fast the exports actually recover. As of now, the exports are actually is unlikely to recover in a hurry, given that there has been second wave in US and other countries. So maybe this year the export growth will not improve in a hurry. So if it doesn't improve and the imports continue to be, because we have 30% of our imports are oil imports. So if that is the case, I think current account returning to deficit, of course it will return into deficit, but that may be a little bit prolonged. if the
Mm.
current rate continues.
Right. And so another factor that everyone's watching out for is how fast the credit growth picks up from here on. Because RBI has been the first one to react with regards to rate cut. However, transmission was something that was slightly slow. It has started to pick up, but not at the pace that everyone anticipated. What is your opinion on that front? And what, according to you, will ail credit growth? Because clearly it seems that there is a possibility that we may be close to bottoming out now.
See, I think in terms of rate transmission, I'll say that as you know, monetary policy works with long and variable lags. But because of the unconventional monetary policies, this year when the RBI has cut rates by 115 basis points, the transmission has been of 91 basis points. So I think transmission has been the fastest, I think, in the last couple of months after the pandemic because of the surplus liquidity in the system. But in terms of the credit growth, I think this year the credit growth could be I think in single digits, may not be close to 10%. Next year the credit growth will automatically pick up. But the good thing is that retail credit continues to be doing well. But there are sectors like the credit to the industry, specifically the credit to the sectors like the MSME sectors, which where the loan guarantee scheme has been working very well. But I think the government and the banks are also taking showing out all steps to lend to these MSME sector. For example, our bank is trying to follow a co-origination model. So I think credit to the SME sector needs to pick up. But as of now, I think the outlook on the credit growth will be muted this year. Possibly it will pick up next year, but again it will be a slow climb rather than a dramatic climb.
Right. And with this, another factor that we want to understand is as to at what juncture, according to you, should the RBI start withdrawing liquidity from the system?
No, that's actually something which the central bank needs to decide. May not be, I think as of now, the keeping liquidity in the banking system has helped everyone. It has reduced the corporate spreads. It has helped the NBFC borrow at record low rates. It has helped in faster transmission. So my sense is that the central bank would actually look into the liquidity getting, trying to balance out the liquidity maybe from the April monetary policy. So in February, it may give out a hint, but maybe it may not do this next year. But if the numbers of the third quarter shows that the economy has actually, and which will be known only after the RBI policy release in February. So I think we are expecting it could break into very marginal positive numbers. And if that is the case, I think the RBI will definitely try to see how it can balance out the liquidity from the April monetary policy onwards.
Right. And do you think that they should sterilize inflows through issuance of MSS bonds if the flows sustain?
There is a demand for that, the MSS bonds. I think that is one of the possibility which the central banks could look into. But given the fact that that will also give a signal that the RBI is actually trying to balance out the liquidity as of now. I am not sure that the RBI is going to do that right now. It may actually do it at a later stage, because ultimately at the end of the day, it is a scheme of mobilizing the liquidity in the banking system. And we must remember that the total government borrowing program is 12 lakh crores, and the central bank needs to ensure that it goes off at the lowest possible cost, which we have been able to do this year.
Right. And apart from this, Soumya, what's happening is if you see the corporate bond market, the issuances are at record high right now. Do you think this could even thin when the portfolios flows dry up? And secondly, do you think the corporates will find it difficult to roll their cheap finances once the interest rates start going up due to rising inflation? How would we tackle that kind of a situation?
No, see, I think a lot, but that's the point which I mentioned to you. I think if the rates stay at low levels for an extended period of time, it may actually there is a lot of corporates who have rolled over the debt from higher interest and lower interest rate. But for any borrower, if there has been some of the loans which have been extended to the new borrower at the low rate, and where there is a condition of the rates being repriced after a point of time, if the economy doesn't pick up, that could actually pose a problem for those corporates or marketplace in future. In future. So that's something we need to watch out for. But as of now, there has been the restructuring scheme unveiled by the RBI, and also the fact that the June 7 circular and all these things have actually held the banking system tied over the crisis in this year. But uh, and so therefore we are actually anticipating a much lower number under the restructuring schemes, because there has been also a lot of initiatives on the part of the banks and the government in trying to educate everybody, including the borrowers, of the pitfalls of an restructuring scheme whereby you're raking debt, recognize your repayment is other things and other things. So there has been definite advantage of that. But the important point to note here is that we are going to an exceptional period. So maybe the actual picture will start emerging maybe some point in the next fiscal year end or the beginning of the FY22. So, but leaving aside that, as of today, I think the banking sector is unlikely to show a sharp deterioration in asset quality this year, and this is one of the again learning from the pandemic in terms of the financial system.
Right. And very lastly, when you talk about the environment where we are seeing easy liquidity and financial repression, do you think that the disintermediation of credit by the bond market is something which will sustain?
Actually, we are now in a peculiar situation when the borrowing rates of the corporates from the banks are lower than what they were from the corporate bond market. So this is basically, we are actually in a reverse asymmetrical financial, what will say, the asymmetric financial transmission. Ideally, what happens is that the rates in the bond market are always higher than the, the opposite is always the case. So if that is the factor, I think this phenomenon of low rates from the banks and or a significantly difference between the corporate bond market rates and the rates and the bank rates needs to change, because at the end of the day a negative spread between the two, which should have been a positive spread, is not to the interest of the financial markets. So my sense is that possibly these are, we all hope that these are all uh, aspects of the markets which has been unleashed on us because of these currently unprecedented times. And as the economy starts to recover, and you should also remember that India, the COVID, India had felt the heat of COVID in September. The cases are now declining. We hope that the second wave does not hit us. The vaccine starts to isolate, the vaccine starts to work from the beginning of January. So if we take all these factors into consideration, I think maybe not this year, maybe all these things will start to go away next year in a graded manner. Until then, we need to keep our fingers crossed, but we also need to understand that the people in the system, and that's the most important point, people in the system are now immune to basically the fact that this virus is going to stay here. So let us not impact our day-to-day habit of of not going out, staying isolated and like that. So that's the best thing which this pandemic has actually taught the Indian people. And India is perhaps one of the only countries whereby even the cases, even after the economy was opened up, the Google mobility has risen and the economy has not contracted but actually expanded. I think yesterday the power consumption was at its highest level that we have seen from 2019. So all these are good omens, but let's try to see that these good omens are sustained in the new year, which is coming tomorrow.
Right. And Soumya, my very last question to you is with regards to the bond markets. What's your view on that front? Because if you see the spread between the 1 year and the 10 year, that has widened. The spread between 5 years and 10 years has also widened. So how are you expecting, that front to pan out? Because clearly now is the time where the government needs to start taking steps to facilitate the Indian bond markets to get included amongst the major global bond indices.
No, I think the bond market, the short term, I think the RBI is also very cognizant of that fact, and it is trying steps to lower the long term rates and increase the short term rates. The unfortunate part is that the spread between the reverse repo and the repo is now 65 basis points. So I think once the economy starts normalizing, the RBI could actually think of reducing the spread in terms of hiking the reverse repo rate fast. So that could actually push up the short-term rates. And if the long-term rates remains at the current level, which the RBI is trying to do through its numerous unconventional monetary policies like Operation Twist and liquidity, OMO operations and other things, I think the spread could actually narrow down a little bit. So my sense is that the long-term rates needs to come down a little bit and the short-term rates needs to go up, so that will be good for everyone in the market in terms of the positioning and signaling and expectation.
Absolutely. Hoping that everything falls in place as expected. Thank you, Soumya, so much for joining us on the show. It was a pleasure to speak to you. Great insights. I hope you enjoyed the conversation as well, and hoping to speak to you soon again once things start to improve. Happy New Year and stay safe.
Thank you.